The story of Keith Gill, known to many as Roaring Kitty on YouTube and Deepacking Value on Reddit, represents one of the most extraordinary tales of individual investing in modern financial history. It is a saga where a relatively modest initial investment of $53,000 in GameStop transformed into an astounding $50 million, a journey that captivated the world and challenged the very foundations of Wall Street. This isn't just a story of immense personal wealth creation. It's a profound case study demonstrating the potent combination of meticulous analytical insight, unwavering conviction, and the often unpredictable yet powerful dynamics of market mechanisms. Gill's journey underscores how deep research, coupled with a keen understanding of market structure and human behavior, can lead to truly unprecedented outcomes, even against seemingly insurmountable odds. His unique blend of detailed financial analysis and engaging online communication created a phenomenon that continues to resonate today. In June 2019, Keith Gill initiated his now legendary position in GameStop, GME, a company that many on Wall Street had written off as a relic of a bygone era. His initial investment, approximately $53,000, was strategically allocated across common shares and long-term call options, a calculated move designed to maximize potential returns. The average price at which he acquired his shares hovered around $5 per share, a valuation that, in his view, presented a significant opportunity. This entry point was crucial, establishing a low-cost basis that would later amplify his gains exponentially as the stock price began its ascent. His methodology was rooted deeply in the principles of deep value investing, a philosophy that seeks out companies whose intrinsic value is believed to be significantly higher than their current market price. Deep value investing, as practiced by Gill, involves a rigorous search for businesses that are trading below their true worth due to temporary setbacks or market misperceptions. It's a contrarian approach, often requiring investors to go against the prevailing sentiment and hold positions for extended periods, patiently waiting for the market to recognize the inherent value. Legendary investors like Benjamin Graham, the father of value investing, championed this method, focusing on a company's assets, earnings power, and long-term prospects rather than short-term market fluctuations. Gill's adherence to these principles positioned him as a thoughtful, disciplined investor, not merely a speculator chasing quick gains. He saw a tangible business with a customer base, not just a declining retail chain, and believed its future was brighter than its present valuation suggested. Gill firmly believed that GameStop, despite its struggles, was fundamentally undervalued by the broader market. He argued that the market had disproportionately exaggerated the threat posed by the industry's shift towards digital game distribution, while simultaneously overlooking the company's inherent strengths and potential for strategic transformation. For instance, he recognized GameStop's established brand recognition, its vast network of physical stores as potential hubs for a new retail model, and its loyal customer base, particularly for pre-owned games and collectibles, as significant, yet unappreciated assets. His analysis went beyond surface-level narratives, delving into the underlying financials and operational realities of the business. This contrarian viewpoint was central to his investment thesis, positioning him against the prevailing sentiment of many institutional investors who saw GameStop as a dying enterprise. A critical component of Gill's analytical framework was his identification of an unusually high level of short interest in GameStop shares. Short selling, a strategy where investors borrow shares, sell them, and hope to buy them back at a lower price to return them to the lender, was rampant for GME. This meant a substantial portion of the company's publicly traded shares were effectively betting against its success, creating a volatile environment ripe for a short squeeze. The short interest in GME at one point reached approximately 140% of its public float, an extraordinary figure indicating that investors had borrowed and sold more shares than were actually available to trade. Such an extreme level of shorting creates a precarious situation for the short sellers themselves, making them highly vulnerable to any upward price movement. Gill recognized this extreme short interest as a powder keg, waiting for a spark, understanding that any positive catalyst could trigger a massive forced buying spree by short sellers scrambling to cover their positions. When the price of a heavily shorted stock begins to rise, short sellers face increasing paper losses. If these losses become too substantial, their brokers may issue margin calls, demanding additional collateral or forcing them to buy back shares to close their positions, regardless of the price. This forced buying, known as a short squeeze, creates a self-reinforcing upward spiral, as more buying drives the price higher, which in turn forces even more short sellers to cover. The sheer volume of shorted shares made GME a prime candidate for such an event, a situation where the short sellers had effectively trapped themselves in a precarious position. Furthermore, Gill meticulously analyzed GameStop's aggressive share repurchase programs, interpreting them as a strong positive signal from the company's management. When a company buys back its own shares, it reduces the number of outstanding shares, which can increase earnings per share, and signal management's belief that the stock is undervalued. These buybacks indicated that the company itself believed its stock was undervalued and was actively working to return value to shareholders, a move often seen as a sign of financial health and confidence. Such corporate actions provided additional validation for his deep value thesis, reinforcing his belief that the company was on a path toward recovery and improved financial performance. This internal commitment to enhancing shareholder value contrasted sharply with the market's overwhelmingly bearish outlook, further solidifying Gill's conviction and providing a strong fundamental argument for his investment. His strategic use of call options was another masterstroke, allowing him to achieve significant leverage on his investment. Call options provide the right, but not the obligation, to buy a stock at a specified price, the strike price, before a certain date, the expiration date. By purchasing long-term call options, Gill was able to control a much larger number of shares for a relatively small capital outlay compared to buying the shares outright. For example, owning 100 shares might cost $500 at $5 per share, but a call option for those same 100 shares could cost a fraction of that, offering immense upside potential with limited downside risk to the premium paid. This strategy dramatically amplified his potential returns in the event of a significant price increase, turning a modest capital base into a formidable position with immense upside. The foresight to employ options in this manner was key to scaling his gains far beyond what a simple stock purchase could have achieved, showcasing a sophisticated understanding of financial instruments. Keith Gill didn't just invest, he became an evangelist for his thesis, openly sharing his detailed investment analysis and regular updates on his position with a growing online community. He posted under the pseudonym U/DeepikingValue on the Reddit subreddit r/Wall Street Bets and cultivated a following on YouTube as Roaring Kitty, where he conducted live streams and uploaded videos. His content was characterized by its transparency, featuring detailed spreadsheets, thorough fundamental analysis, and a straightforward explanation of his rationale, which resonated deeply with retail investors. He would meticulously break down financial statements, discuss management changes, and patiently explain his long-term vision for GameStop, often with a quirky, approachable style, making complex financial concepts accessible. This open approach fostered trust and attracted a significant number of followers who, convinced by his compelling arguments and meticulous due diligence, also began to invest in GME. The power of social media proved to be an indispensable catalyst in the GameStop saga, transforming Gill's individual conviction into a collective movement. His straightforward, spreadsheet-filled content, combined with his demonstrable due diligence, built a loyal following that extended far beyond the typical retail investor. These followers weren't just passively observing, they were actively engaging, discussing, and ultimately investing alongside him, often sharing their own research and encouraging others. The decentralized nature of platforms like Reddit allowed for rapid dissemination of information and a shared sense of purpose, creating a powerful network effect that amplified Gill's message and attracted even more participants to the GME trade. This organic, community-driven engagement was unlike anything Wall Street had seen before, showcasing the democratization of financial information and the power of collective action. The culture within r/Wall Street bets, characterized by its irreverent humor and a shared disdain for institutional short sellers, provided a fertile ground for Gill's message to flourish. Terms like diamond hands, holding through volatility, and rocket emojis signifying upward price movement became shorthand for collective conviction and optimism, fostering a sense of shared identity and purpose. This communal aspect fostered a sense of solidarity among retail investors, many of whom felt marginalized by traditional finance and saw Gill as one of their own. Gill, with his calm and logical explanations, became a trusted figure, a beacon of rationality in a sea of speculative fervor, even as the subreddit embraced its chaotic image, providing the analytical backbone for a movement that was often perceived as purely emotional. A pivotal moment arrived in August 2020 with the investment of Ryan Cohen, the highly successful founder of the online pet supply retailer Chewy. Cohen's decision to take a significant stake in GameStop, coupled with his subsequent appointment to the company's board of directors in January 2021, served as a potent additional catalyst. His reputation as a visionary e-commerce entrepreneur and his stated intention to transform GameStop into a digital-first retailer, leveraging its existing brand and customer base, injected a much-needed dose of optimism into the struggling company. Cohen's track record with Chewy, where he successfully built a thriving online business from scratch, lent immense credibility to the idea of GameStop's potential revitalization, a crucial endorsement for Gill's thesis. This development fundamentally altered market sentiment, providing a credible pathway for the transformation that Gill had initially envisioned, and giving retail investors further confidence in their collective bet. Cohen's involvement was a clear signal that GameStop had a serious plan for adapting to the modern retail landscape, moving beyond its traditional brick-and-mortar model, which many had deemed obsolete. His strategic vision, focusing on an enhanced online presence, improved customer experience, and a more diversified product offering, resonated with Gill's thesis of an undervalued company with untapped potential. The market, initially skeptical, began to take notice, recognizing the serious intent behind GameStop's efforts to evolve, thereby adding a powerful institutional validation to the retail movement. The stage was now perfectly set for the short squeeze, a phenomenon that would catapult GameStop's stock price to unprecedented heights. To fully grasp this, it's essential to understand short selling. Essentially, short sellers borrow shares they don't own, sell them on the open market, and hope the price drops so they can buy them back cheaper, return them to the lender, and profit from the difference. This strategy carries unlimited risk, as a stock's price can theoretically rise indefinitely. The more it rises, the greater the potential loss for the short seller, creating immense pressure to cover their positions. They are essentially betting against the company's future, and if the company thrives, their losses mount quickly, demanding immediate action to mitigate further damage. In GameStop's case, the short interest was not just high, it was astronomically high, reaching approximately 140% of the company's free-floating shares. This meant that more shares had been sold short than actually existed in the public market, an anomaly that underscored the extreme bearish sentiment surrounding the stock. Such an exaggerated short position created a powder keg, as Gill had identified, a situation where any upward movement in price could trigger a cascade of forced buying. This high short interest also meant that a significant portion of the market was betting on GameStop's demise, creating a stark contrast with Gill's bullish outlook and setting the stage for a dramatic confrontation between institutional bears and retail bulls. The launch of the short squeeze was initiated by the collective purchasing power of retail investors, largely inspired by Keith Gill's persistent advocacy and the growing community on Reddit. As these individual investors began to buy GME shares, driven by conviction and a desire to challenge institutional short sellers, the price started to tick upwards, albeit gradually at first. This initial ascent, however, was enough to trigger margin calls for some short sellers, forcing them to buy back shares to meet collateral requirements and prevent further losses. This forced buying, in turn, pushed the price even higher, creating a self-reinforcing feedback loop that accelerated the stock's upward momentum into a frantic rally. The snowball effect became unstoppable as more and more short positions needed to be closed, creating a desperate scramble among short sellers. Adding another layer of complexity and accelerant to the squeeze was the gamma squeeze effect. This phenomenon is tied to options trading, specifically call options. As the price of GameStop shares began to rise, the call options that many investors, including Gill, held became in the money or closer to it, meaning they were more likely to be profitable. The institutions that sold these call options to investors often hedge their positions by buying the underlying stock to offset their potential liability if the options are exercised. As the stock price rises and the options become more likely to be exercised, these option sellers must buy more and more shares to maintain their hedge, further increasing demand for the stock. This additional buying pressure from options market makers acted as another powerful engine, propelling GME's price even higher and intensifying the squeeze, creating a feedback loop between the options and stock markets that few had anticipated. The exponential growth in the value of Keith Gill's investment was nothing short of breathtaking. From his initial $53,000, his position swelled dramatically as GameStop's stock price rocketed upwards. By January 27, 2021, Gill's holdings were estimated to be valued at approximately $48 million, a figure that for many would represent a lifetime of financial security. However, some reports indicate that his total position, factoring in options and shares, reached and even exceeded $50 million by that same month, underscoring the incredible speed and scale of his returns. This rapid accumulation of wealth from a relatively modest starting point illustrated the immense power of leverage combined with a correctly identified market anomaly, demonstrating the profound impact of a well-timed, high-conviction trade. At the peak of the extraordinary rally on January 27, 2021, GameStop's share price soared to unprecedented levels, briefly touching over $500 per share in pre-market trading before a subsequent stock split. This dizzying height represented an astronomical return for those who had invested early, like Gill, transforming their portfolios almost overnight. The sheer volatility and rapid ascent of the stock captured global attention, becoming a symbol of the burgeoning power of retail investors against the entrenched might of institutional finance. The price action was a spectacle, an almost unbelievable display of market forces driven by community and conviction, leaving many observers in awe of its ferocity and challenging conventional market wisdom. Despite witnessing such monumental, life-changing gains, Keith Gill famously demonstrated diamond hands, a term popularized on social media to describe investors who hold onto their positions through extreme volatility and temptation to sell. He not only maintained his substantial holdings, but, at one point, even converted his call options into common shares, effectively doubling down on his position as the stock soared. This act of unwavering conviction, choosing to hold and even increase his stake rather than cash out, became a rallying cry for his followers and a testament to his deeply held belief in GameStop's long-term potential. His steadfastness in the face of immense profit was remarkable and inspired many, solidifying his status as a legend among retail investors and a symbol of resilience. Gill's public statements throughout this period were characterized by a humble yet firm resolve. He openly admitted that he never expected what happened over the last week, acknowledging the unforeseen magnitude of the short squeeze. Yet he remained steadfast in his conviction regarding his original investment thesis, famously proclaiming, "I like the stock." This simple, iconic phrase encapsulated his unwavering belief in the fundamental value of GameStop, irrespective of the speculative frenzy surrounding it. His calm demeanor and consistent message provided a focal point for the retail investor community, reinforcing their collective determination to hold their positions and resist the urge to sell, even as the price fluctuated wildly and external pressures mounted. The GameStop saga had far-reaching implications, sending shockwaves across the financial markets and causing significant financial repercussions for several prominent hedge funds. Melvin Capital, one of the primary short sellers of GME, famously suffered massive losses, requiring a multi-billion-dollar bailout from other hedge funds to avoid collapse. This event exposed the vulnerabilities of highly leveraged short positions and highlighted the potential for collective retail action to disrupt established market dynamics. The sheer scale of the losses incurred by institutional investors underscored the unprecedented nature of the short squeeze and its capacity to inflict serious damage on professional money managers, demonstrating that even sophisticated players are not immune to market forces and the power of a coordinated movement. Beyond the immediate financial impact, the GameStop phenomenon attracted intense scrutiny from financial regulators worldwide. Questions were raised about market manipulation, the role of social media in influencing stock prices, and the fairness of trading platforms that temporarily restricted buying of GME shares during the peak of the squeeze. Congressional hearings were convened, with Keith Gill himself testifying, and discussions about market structure, transparency, and investor protection became central to the financial discourse. The saga forced a re-evaluation of long-held assumptions about market efficiency and the power balance between institutional and retail investors, prompting calls for potential reforms to ensure a more level playing field and prevent similar disruptions in the future. The story of Keith Gill transforming $53,000 into $50 million through his GameStop investment stands as a testament to the confluence of several critical factors. His journey began with a profound and meticulous deep value analysis, identifying GameStop as a fundamentally undervalued company with overlooked potential. This analytical rigor formed the bedrock of his conviction, allowing him to see opportunity where others saw only decline, even when the mainstream financial world had largely dismissed the company. He didn't just guess. He researched, crunched numbers, and developed a robust thesis that stood the test of time, even in the face of widespread skepticism from Wall Street, proving the power of independent thought. Complementing his fundamental analysis was the strategic and insightful use of options for leverage. By employing long-term call options, Gill was able to magnify his exposure to GameStop's potential upside while managing his initial capital outlay. This sophisticated financial strategy was crucial in accelerating his returns, transforming what would have been substantial gains from stock appreciation into truly astronomical figures. His understanding of how options could be used to amplify returns, particularly in a high-conviction trade, showcased a level of financial acumen that went beyond simple stock picking, demonstrating a mastery of complex financial instruments and their strategic application. Furthermore, Gill's decision to publicly share and articulate his investment thesis played a catalytic role, fostering a vibrant and engaged community of retail investors. His transparent approach on Reddit and YouTube, complete with detailed explanations and unwavering conviction, resonated deeply with individuals seeking to understand and participate in the markets. This open communication built trust and galvanized a collective interest in GME, turning a personal investment into a shared mission. The power of this online community proved to be an unexpected yet decisive force in the unfolding drama, showcasing the new dynamics of investor influence and the potential for decentralized coordination. The culmination of these factors, deep value analysis, strategic options use, and public advocacy, converged with the unique market condition of an extremely high short interest in GameStop. This created the perfect storm for an unprecedented short squeeze where collective buying by retail investors forced short sellers to cover their positions, driving the stock price exponentially higher. It was a rare alignment of fundamental opportunity, strategic execution, and market mechanics that created a truly unique and historic event in financial markets. The interplay between these elements was complex, yet ultimately yielded extraordinary results, forever changing how many perceive the power of coordinated retail action and the vulnerabilities of heavily shorted stocks. It is crucial to emphasize that Keith Gill's remarkable financial success was far from a mere stroke of luck or a random gamble. Instead, it was the direct outcome of a carefully considered and well-executed strategy, one that happened to intersect with a set of specific and highly unusual market conditions. His deep dive into GameStop's financials, his recognition of the potential for a short squeeze, and his courage to stand by his convictions against the tide of institutional skepticism all contributed to his triumph. This story serves as a powerful reminder that while markets can be unpredictable, thorough preparation and unwavering belief in one's research can sometimes lead to outcomes that defy conventional wisdom and redefine market power dynamics, offering profound lessons for all investors. This incredible journey of financial transformation also offers valuable lessons for anyone interested in the intricacies of the stock market and the potential for individual investors to make a significant impact. It highlights the importance of independent research, the courage to hold a contrarian view, and the understanding that sometimes the collective power of many can challenge even the most established players. The GameStop saga is not just a tale of wealth, but a narrative about challenging narratives, about conviction in the face of doubt, and about the evolving landscape of modern finance, proving that the underdog can sometimes prevail against the giants. It's a testament to the idea that thoughtful analysis, when combined with unique market conditions, can create opportunities rarely seen. Understanding these complex financial events, from historical crises to the strategies of legendary investors, can provide invaluable context for today's market dynamics. If you're fascinated by the stories behind the headlines, the profound impacts of economic shifts, and the brilliant minds that have shaped the financial world, then you'll find a treasure trove of content on the Wall Street Memoirs channel. This channel offers a deep dive into the most pivotal historical events that have defined financial markets, dissects the causes and consequences of major financial crises, and illuminates the lives and strategies of prominent figures who have left an indelible mark on Wall Street. By exploring these rich narratives, you gain a deeper appreciation for the forces that drive markets, the intricate interplay of human psychology and economics, and the often surprising lessons that history offers to contemporary investors. Wall Street Memoirs provides perspectives that enrich your understanding of finance far beyond what a single news cycle can provide, offering timeless insights into market behavior and investment philosophy. Whether you're a seasoned investor or just starting your financial journey, learning from the past can equip you with a stronger foundation for navigating the future. Consider subscribing to Wall Street Memoirs today. The link is conveniently located in the description below, and it's an excellent resource for anyone looking to expand their knowledge of financial history and gain insights that are surprisingly relevant to current market trends. Don't miss out on the opportunity to delve into the captivating stories that have shaped our financial world and refine your own investment perspective. The GameStop phenomenon, largely spearheaded by Gill's initial insights and unwavering commitment, undeniably left an indelible mark on the financial world, forever altering perceptions of retail investor power. His methodical approach, combined with a unique set of market circumstances, created a blueprint for understanding how concentrated retail enthusiasm can force the hands of large institutions. This entire saga continues to be studied and debated, cementing its place as a pivotal moment in the ongoing evolution of financial markets. It's a story that will undoubtedly be told for generations, a modern legend illustrating the triumph of conviction and community against the established order, a true David versus Goliath tale that captivated the globe and changed many fundamental assumptions about market control.